Hello, I'm Debbie Bell-Hosking here at Cybos 2017 in Toronto. There's been a lot of talk about deglobalization, particularly in the wake of headlines like America First and Brexit means Brexit. World trade growth has dropped less than world GDP growth. And to join me to discuss what does this mean for cross-border trade and the finance of it are trade economist Dr. Rebecca Harding and Deutsche Bank's Global Head of Trade Finance, Daniel Schmand. Welcome.
Thank you.
Thank you.
So the big question is, has trade lost its mojo? And if this is so, how does this affect the demand for trade finance?
So I think to some extent, if I can take that first,
Yeah,
the problem that we're seeing is that since 2012, trade growth really has fallen back. 2017 is proving to be quite a mixed picture. So actually, if you look back since 2010, the rates of growth month on month kind of do this. So it's stayed flat for a very long time, and that is a concern for anyone who's in the sector.
Yeah, I can just add to that one. So we have seen, next to the fact that trade is not growing, also there is ample liquidity in the market, and there are ample players to basically place liquidity, and there is a run on trade finance assets. So yes, it is difficult. Having said that, I like just one point, and I guess it came from the Asian Development Bank. There is still on the SME sector a trade finance gap of 1.7 trillion. So there are pockets where there might be potential growth.
So I'd just like to add to that. So what we're seeing in trade finance actually is quite almost a paradoxical situation. So on one hand, we're seeing lots of liquidity in the market, and there's been a huge amount of growth in the trade finance market in Asia up until between 2012 and 2014. And what happened then was increasing regulations, very much tighter AML, KYC regulations, and that's actually pulled banks back. At the same time, we've seen very low interest rates and quantitative easing producing that liquidity in the marketplace, and it's meant that the trade finance sector is trying to get more out of less in lots of ways. It's not profitable, so it's been very difficult to work in that sector. And I think there are huge opportunities out there with this 1.6 trillion, because it's there that technology can help, it's there that digitalisation can help. So there are opportunities out there.
I totally agree to that.
Now, you mentioned technology.
Yeah.
Does it not shorten supply chains? And also, how does this affect the guaranteeing of bank loans?
Maybe I'll take the first shot on that one. So first and foremost, I would call technology always an enabler to basically make processes and smoother, to help easier client access, to get things more efficiently done. On the sheer financing of a transaction, that is where banks are most interested in, that is not as much affected on technology. Having said that, and I'll just have a different angle to that one, is also we need to adjust ourselves of doing business to things like 3D printing, which might happen on the ground, and the export angle is gone away. However, then the 3D printing happens in an emerging markets, and the emerging markets finance is still there. So it is a shift, but there is still an opportunity for us as banks to finance those projects.
Yeah, and I think honestly you've made a really good point there about 3D printing, and you've got manufacturing as a service. You've got so much bedded into the value of trade now that it's almost impossible to measure what trade actually is. And so some of what we might be seeing at the moment with the drop back in trade is actually an awful lot more happening through things like happening in the ether through 3D printing and so on and so forth. And I think, I'm an economist, there's a law in economics that if you start to measure something, it starts to become the wrong thing, And I think to some extent, there are opportunities out there with new technology that we're maybe not seeing at the minute.
And there's also very positive signals on that side. If you just go to China and their One Road, One Belt project, and I always remind people there's as well the maritime, as well as the terrestrial growth. That's a huge opportunity for banks and trade finance. So as much we are struggling a little bit, there's also positive news. And one should also not forget, to all what we mentioned earlier, there was also a deep drop in commodity prices. So a tank of oil, which we financed in 2011 at $100 million, was then worth $30 million or $20 million. That has also now rebounded. So there is a lot of factors coming in. And I would also say what is also has not helped trade is the geopolitical uncertainty. We have more and more sanctions, sectorial sanctions, partial sanctions, and that is also not helping trade and the confidence level. Trade works on a confidence level.
Yeah. So I think that's unbelievably important. At the moment, businesses and banks are operating in an environment of geopolitical uncertainty, and the extent to which, so I've just written a book called The Weaponization of Trade, and I'm arguing that trade has actually been weaponized. So through sanctions, through using it as a tool of foreign policy, actually the sector that we actually thought was a benign instrument of economic growth where we could have win-win situations over the last 30 years, that's been the case. We're suddenly in an environment where it's being treated as one where you can have a trade war, where you can have enemies, we build walls, and that's a very difficult environment. But there are, as Daniel said, big opportunities. So, I mean, I think Germany and China are actually very well placed at the moment. I'm calling them the new globalists because China has this amazing infrastructure project across the whole of Eurasia and into Europe and around the maritime areas as well. It's over 60 countries in the world. It's a quarter of all goods and services, $2 to $3 trillion worth of trade finance around all of that. China's not going to be able to fund all of that. And Germany is in a position where it's a globalist too. It lives in a global world, and Germany is able to supply infrastructures and finance into that market. It's a massive opportunity.
So let's return to the theme of economic nationalism. It appears that the UK and the USA are going it on their own, whereas China has become the champion of the WTO with its, as you mentioned, the One Belt, One Road policy. And you speak about opportunities, and you have done so. Could you elaborate a bit more on that?
Maybe I just step in with an example, and then we'll take it a bit broader. So, look, if you just see that they want to build a new deep sea port in Pakistan. What does that actually mean? It's not just the infrastructure, it's all of the supply of technical equipment, of the cranes, of certain things. So you almost, it's a catalyst also for the developed market to bring in capital goods, to help countries like China to enlarge their influence, but also, and that is for me an important point, you have almost like a financial inclusion of a country like Pakistan. They also benefit. So you have almost three parties in just one example who hugely benefit from such a large infrastructure program.
And I think I'd add to that actually countries other than China developed countries have a responsibility to work with China on this, because yes, China is seeing this as a way of increasing its strategic influence across the region. Let's not be naive about that. A lot of it is about commodities, a lot of it is about oil supply. Let's not be naive. But if countries like Germany, the UK, Europe, even America can get involved with some of these projects, then it actually dilutes the Chinese influence. It means that it's truly a global project, and it states that the world is not accepting unilateralism anymore, that we live in a multilateral world, that globalization is important, and this is one of the big opportunities that's out there.
And like you're also first time connecting Africa in a larger multi-African program, which is not driven by the Africans, which is interesting, and make them part of the entire supply chain. If you just see also then the shoe manufacturing is already moving from Asia to Ethiopia, so there is a knock-on effect next to the infrastructure, because the infrastructure is just an enabler for other services and industries to follow. So I'm hugely positive about those developments.
I think it's, I mean, you look at the amount of money that's involved, it cannot just be funded by China, because the Chinese economy is not as strong as everybody thinks it is. And China has been adjusting its economy, and now it's saying we want to bring some of these advantages of being an export-led economy to some of these emerging economies as well. Yes, it increases their influence, but it also means that other countries have to come in and help finance that, because if they don't, the project won't happen. Because China doesn't has less than a tenth of the money available to it that it needs in order to be able to make this work.
And definitely the European and other ECAs are more than happy to step in, because it's capital goods. Yeah. It's basically jobs in Germany, in France. Yeah. So it's that real win-win situation. As you alluded to, China cannot finance it all in its own. So content from other countries are also important, because with the content, also the financing comes.
And we have to believe it's the end of isolationism. This is the future. Mm.
So we are seeing a change in the way trade is being done. Yeah. So what do you both foresee for the next 5 years?
I wish I would exactly know what happens the next 5 years. I just want to touch on one point, because we've not touched that really, and usually you need to touch that, and that is everything around blockchain and distributed ledger and smart contracts. So my big hope is that over the next 5 years, we will have so-called blockchain or smart contract rules, because the technology is ready and there. What is missing is the legal ecosystem and frameworks to basically support also SMEs and smaller countries and smaller players to engage in an easy access platform. So that is my outlook for the next 5 years, having those blockchain uniform practices and then enabling a broader inclusion of SMEs. That would be the next boost to the trade finance and trade finance industry.
And Rebecca?
And so my view is that we're actually at a very important historical juncture at the moment. So in economic terms, we have a choice. We can go down an economic nationalism route, or we can go down a new globalism route. And I think if we make the right choices, and I believe everyone in this sector is making the right choice, it is about digitalisation, it is about inclusion, it's about financial inclusion, because we have to learn the lesson that we did not include everybody in that global phase. We have to learn that lesson and say we need to do it differently now. And if we choose that neo-globalisation route, I think we're in a very strong position. There are a lot of opportunities out there.
Next 5 years is about inclusion rather than exclusion.
I agree.
Great, we're in agreement. And on that note, may I say thank you, Rebecca, thank you, Daniel.
Thank you so much.
Thank you very much.
And thank you for watching.